There is a lot of concern right now that interest rates and the possibility that they don't go down nearly as quickly as people thought will drive the rest of the market narrative in 2024. What's the take? Are interest rates going to be the key to whether or not markets can sustain the path they've been on for a while now?
Yeah, so we would say that the base case for our view on the economy is that there's still a lot of resilience in the economy. And so we're going to have to see more of this economic data, more in the jobs reports, more on the CPI reports that are coming up in the next couple of weeks to understand if this is a trend, as you mentioned in the prior segment. But what is going to continue, if rates don't come down as fast as investors were expecting in 2024, that means that there's a lot of opportunity for investors in bonds in particular. And if those rates stay higher and rates are higher for longer, that can mean that investors have an opportunity to be taking advantage of that right now, as they have in 2023. So that's something we're pointing investors to, is maybe not focus so much on the equity volatility, but focus on the opportunities in the bond markets.
So where are those opportunities? I mean, the idea here is that equity markets, despite the sell-off, still remain near record highs. At the same time, folks can collect 4 to 5% risk-free in the market from money market funds and U.S. Treasuries. Are there better places, though, for people to focus on to get that income generation besides just Treasuries and money market funds?
Yeah, so we think of there's two steps right now. When you think about bonds versus equities, bonds have income, they have coupons, and so they support, as rates are rising, they support any of the volatility and their prices going down. So there's a lot less volatility, a lot smoother ride in investing in bonds. So our first step is just to move out from those really short duration treasury products or short products like 6 month and 1 year, and into something more intermediate. Even if you just look at treasuries and you invest in the 2 year, 3 year, 5 year, 7 year, we're recommending that space, the intermediate space, the belly space, because even though there may be volatility coming up, the bumps in the road will probably be a lot smoother in that space versus going all the way out to the 10 year or the 20 year. And then there's a very smart, intuitive trade here. Because the economy is so resilient, corporations are issuing, and their bonds have very high income right now. So we're recommending credit. We think that something like a BBB credit, which is investment grade, is the place to be.
Joanna, BBB sounds good, and those companies always seem to make their payments on time. There are, though, folks who want to go out maybe a little bit more on the risk spectrum. They want to look at high yield. They want to look at junk-rated debt. Is it still safe to go into those parts of the market that yield perhaps more than 6, 7%, given the fact that these credit markets and the economy are doing okay?
We are very positive on high yield because of the resilience in the economy and the strength and the fundamentals that corporations continue to post every quarter. And so it's hard to look away from a 12% yield in high yield in the CCC space. It's done really well. It's been the best performing category in fixed income in 2023. It continues to pay that coupon. And again, because the coupon rate is so high in high yield, it cushions any of the price volatility on the way down. And let's remember that the case for 2024 is that inflation will meet its Fed target at some point, and that rates will start to soften and come down. So we think we're at peak rates. And when you are at peak rates, that means that rates will come down. And now you're going to be benefiting in fixed income from, a tailwind of total return.